Welcome to another episode of Millennial Investing Explained. Here's today's question. What is a common piece of advice that you often hear experts giving about real estate investing that you don't think is necessarily true?
I think the first thing that I hear more and more often these days is people saying, well, because the nation it is aging and millennials are so burdened with, student debt, we think that even if a recession comes, rentals are going to do well. I can tell you whether it's single family rentals or it's multifamily rentals, there's no reason why the rental market would not take a hit for a recession. I do not want you guys to start off on the wrong foot thinking that you're in some magical fairyland where nothing ever goes wrong simply because the millennials don't have money to buy homes or simply because people are getting older. That's nonsense. The data does not suggest anything like that. Be prepared for the fact that when the next recession comes, whenever the heck it comes, it's been coming for 6 years now, might be coming for the next 6 as well. When it comes, you'll get hit. That's no reason not to invest in real estate, but that's a reason to be cautious then. That's a reason to have extra reserves. That's a reason to be careful and honest with your investors. They're going to appreciate your honesty. So I hear a lot of people have these stars in their eyes where they think that something magical has happened where rentals will only ever go up. And they even tell other people on Facebook about it. And I find it to be nonsensical.
Is there anything about investing in the cities that you recommend that would help through a downturn? Do those cities, because they have those characteristics, do they do better in downturns?
I'd say the downturn might be slightly shallower, but no, I don't expect that to be a lot better. What I do expect is that the upturn after the downturn in those cities will be sharper and will last a lot longer. So yes, you get the benefits, but during the recession, most cities kind of sort of resemble each other. They're not substantially better. They're going to be slightly better, I think. But I think at the end of a recession, a city like Phoenix is likely to recover much faster than a city like Cleveland because the demographics of Phoenix are across the board better.
So if this impending downturn is coming, why would an investor invest now versus potentially waiting on the sidelines until that time comes and then jumping in?
Because the biggest opportunity is to buy the dip. Okay, you can't buy the dip at that point of time. You can't raise enough money. You've got to get in now. So by the time the recession comes, maybe it's coming in 18 months, you've got a pool of investors and you can convince them, oh, investors, here's the dip. Here's the buying opportunity. Do you think that it makes sense to build your credibility in the middle of a recession? No, build it now and you'll have the money to buy in that dip. That is so important. And it makes so much sense when I say it, but people are like, I'm just going to wait until the dip. Well, where are you going to get the money in the dip? Nobody wants to invest at that point of time unless they already have a relationship with you, in which case they'll invest because it'll make sense to them that you're buying in the dip. Those relationships have to be built now while it's easy to find investors.
What if somebody isn't raising money from an outside investor? What if somebody has $25,000, $30,000 that they're going to put into a small duplex or triplex or even a quadplex and just use their own money? Should they wait for the dip?
If your only strategy is to invest your own money, I think it makes sense. Yes. Wait.
Got it. That's all for this episode of Millennial Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.